Most of us grew up hearing that cash is king. It sounds safe, solid, and simple. You can hold it, count it, stash it away. But what if I told you that keeping too much cash could quietly be one of the riskiest financial moves you can make? Let's unpack that. When you think of risk, you probably imagine the stock market crashing, crypto prices tumbling, or real estate bubbles bursting. Cash feels like the opposite of all that, steady and predictable. But the biggest danger with cash isn't that it disappears overnight, it's that it quietly loses power, little by little, every single year. Inflation is the invisible tax that eats your money while you sleep. It doesn't make headlines every day, but it's always there. In 2021, U.S. inflation averaged around 4.7%, the highest in 30 years. In 2022, it spiked above 8%, the fastest pace since the early 1980s. Even though it cooled down to around 3% in 2023 and 2024, prices didn't fall, they just stopped rising as fast. That means the coffee that cost $3 a few years ago might still be $4 today, and it's never going back down. If you had $10,000 in cash sitting in a drawer in 2021, by 2024, that same $10,000 can only buy about $9,000 worth of goods in real terms. You didn't lose the money, but you lost the value. And that's the quiet danger of holding cash. Here's the tricky part. Our brains aren't wired to feel inflation's effect. When we see the same number in our bank account, it feels safe, but the purchasing power behind that number keeps shrinking. It's like holding an ice cube in your hand. It looks solid, but it's melting, slowly, silently, and inevitably. Now, someone might say, but at least my money isn't at risk in the market. That's true, you're avoiding volatility, but you're trading visible risk for invisible erosion, and in the long run, that's often worse. Let's put some numbers on it. Historically, inflation in the U.S. has averaged around 3% per year. That means money loses about half its value every 24 years. $100 today could be worth only $50 in terms of buying power by the time a newborn hits college age. If inflation averages 4%, it happens in just 18 years. Think about your emergency fund, maybe $20,000 saved up. It feels good to have that cushion, but if it sits untouched for 10 years with no interest and inflation averages 3%, its real value drops to about $14,800. That's a $5,200 loss in what your money can actually buy, and you didn't even spend a dollar. The truth is, cash safety is an illusion. It protects you from short-term market swings, but it exposes you to long-term purchasing power decay. It's like standing still on a moving walkway that's going backward. You might not notice it for a while, but eventually you'll find yourself behind. Now, some people might argue, but what if the market crashes? I'll be glad I kept cash. And yes, in the short term, cash gives you flexibility. It's the dry powder that lets you buy assets when they're cheap. But as a long-term store of value, it's one of the weakest options available. Let's look at how different assets performed over time. According to historical data from the Federal Reserve and major indexes, the average annual return of U.S. stocks over the past 50 years sits around 10% before inflation, or roughly 7% after inflation. Bonds have averaged around 5 to 6%. Cash savings accounts, on the other hand, usually earn less than 1% after fees and taxes. Even in 2024, when many high-yield savings accounts offer around 4 to 5%, if inflation is roughly 3%, your real return is just 1 to 2%, maybe less after taxes. So while it feels like your balance is growing, the reality is you're barely staying ahead, if at all. And here's another hidden danger: opportunity cost. Every dollar sitting idle in cash is a dollar not compounding elsewhere. Albert Einstein supposedly called compound interest the eighth wonder of the world. Whether or not he actually said it, the math is clear. If you invest $10,000 and earn a modest 7% annual return, it grows to nearly $20,000 in 10 years and over $40,000 in 20 years. Keep that same $10,000 in cash, and in 20 years it's still $10,000, but worth only about $5,500 after inflation. That's the real cost of playing it safe. Now, let's talk psychology. Humans crave certainty. Behavioral economists like Daniel Kahneman have shown that we fear losses about twice as much as we value gains. That's why holding cash feels comforting. You can't lose what you can see. But in finance, comfort can be expensive. The price of safety is often slow decay. Here's a story that illustrates this perfectly. In the early 1990s, a man named John set aside $50,000 as a do-not-touch emergency fund. He felt proud of his discipline. No risky investments, just cash. Fast forward 30 years, that same $50,000 in 1993 could buy the equivalent of about $100,000 worth of goods today. But because he kept it in cash, it still says $50,000 on paper. He lost half his purchasing power, quietly, invisibly, and permanently. Now, let's zoom out to the global picture. Holding cash isn't just risky for individuals, it's risky for entire economies. When large amounts of money sit idle, it slows down growth. In Japan, for instance, households are famous for their high savings rates. For decades, the Japanese economy struggled with deflation and stagnation, partly because consumers hoarded cash instead of spending it or investing it. The Bank of Japan had to push interest rates below zero to encourage people to move their money. Even in the US, the cash under the mattress mindset spiked during uncertain times. In 2020, during the pandemic, Americans collectively saved more than 30% of their disposable income, a record high. But as inflation returned, that stored cash lost value quickly. By 2023, many households realized that their safe savings had quietly shrunk in real terms. Let's talk about another angle: taxes. Most people don't think of inflation as a tax, but that's exactly what it is. When governments print more money, the value of existing money falls. You might not see a deduction on your paycheck, but inflation extracts value just the same. And here's the kicker: the interest you earn on cash in a bank account is taxed as income. So even if your savings account pays 4% and inflation is 3%, after taxes, you might net just 2% or less. That means your real purchasing power is still slipping. So what's the alternative? It's not about abandoning cash entirely. Cash has a purpose. It provides liquidity, stability, and peace of mind. You need some for emergencies, near-term expenses, and opportunities. But beyond that, letting your cash pile grow too large can quietly sabotage your financial goals. A balanced approach works best. Keep enough cash to cover 3 to 6 months of essential expenses, maybe a bit more if your income is unstable. Then put the rest to work. That could mean diversified investments, stocks, bonds, index funds, or even real assets like real estate or commodities. The goal isn't to chase high returns, it's to stay ahead of inflation and harness the power of compounding. Let's do a quick comparison. Imagine two friends, Sarah and Mike. Sarah keeps $50,000 in a high-yield savings account earning 4%. Mike invests $50,000 in a diversified portfolio earning an average of 7% annually. After 10 years, Sarah's account grows to nearly $74,000. Mike's portfolio grows to nearly $98,000. Even if inflation averages 3%, Mike's real wealth, what his money can buy, is significantly higher. Sarah's safety came at a cost of about $24,000 in missed growth. Now, you might think, but what if the market drops? That's a fair concern. Markets do go down. In 2008, the S&P 500 fell nearly 38%. In 2020, it dropped more than 30% in a matter of weeks. But here's the thing, it also recovered. By 2013, the 2008 crash losses were fully recovered. By late 2020, the pandemic crash reversed within months. History shows that staying invested through volatility tends to outperform staying in cash over time. It's like sailing. If you keep your boat anchored forever because you fear storms, you'll never reach new shores. Yes, you'll avoid the waves, but you'll also miss the wind. Let's bring this back to the everyday level. Inflation doesn't just affect investors, it affects everyone. The price of groceries, rent, healthcare, and education all rise over time. In the United States, the average college tuition has increased by more than 160% since 1990. A gallon of milk that cost $2.50 20 years ago might be $4 today, and it's never going back down. Those increases compound just like investment returns, only in the opposite direction. So if your income or your investments aren't growing faster than inflation, you're effectively moving backward. Many people think the solution is to wait until things feel stable before investing, but stability is an illusion. There's always something happening: elections, wars, recessions, pandemics. If you wait for perfect clarity, you'll wait forever. Meanwhile, your cash will keep losing value quietly in the background. Now, let's talk about the digital age and how that changes the equation. With the rise of online banks, fintech apps, and even digital wallets, it's easier than ever to move money around. But convenience doesn't equal growth. Whether your cash sits in a physical safe or an app on your phone, inflation doesn't care. It erodes value all the same. Even stablecoins in the crypto space, digital tokens pegged to the US dollar, face the same issue. If the dollar itself loses purchasing power, so does the stablecoin. Stability doesn't mean preservation of real value, it only preserves the number. And speaking of numbers, consider this. Between 2000 and 2024, the US dollar lost about 45% of its purchasing power. In other words, what cost $100 in 2000 now costs around $185. That's nearly a 2% average inflation rate compounding relentlessly for over 20 years. No one felt it overnight, but everyone paid for it eventually. So what's the right mindset? Think in terms of real returns, not nominal returns. Nominal returns are what you see, the percentage printed on your bank statement. Real returns are what you keep after inflation and taxes. If your savings earned 3% and inflation is 3%, your real return is 0. If inflation is higher, you're losing ground. That's why wealth builders focus on assets that outpace inflation. Stocks, real estate, and certain commodities have historically done that. Even Treasury inflation-protected securities, TIPS, exist for this reason. They're designed to adjust with the inflation rate. They don't make you rich, but they protect your purchasing power better than cash. Let's not forget about global currencies too. If you're holding cash in a single currency, you're exposed to not just domestic inflation, but also exchange rate risk. For example, over the past decade, the euro fell from about $1.40 to roughly $1.08 against the US dollar. That's nearly a 23% drop in value. So even if inflation was moderate in Europe, euro holders still lost international purchasing power. Cash feels safe because it doesn't fluctuate day to day like a stock chart, but that stability is deceptive. It's a slow leak instead of a visible crash, and because it's slow, most people ignore it. Now, there's one more psychological factor worth mentioning: control. People like cash because it feels tangible and controllable. You can hold it, withdraw it, count it. Investments, on the other hand, feel abstract, numbers on a screen that move unpredictably. But control doesn't always equal security. In fact, clinging too tightly to cash can mean losing control over your future purchasing power. So where does that leave us? Keep cash for emergencies. Use it as a tool, not a strategy. Beyond that, let your money work for you, because in a world where inflation never sleeps, idle cash is quietly working against you. The next time someone says cash is king, remember this: even kings lose power if they sit on the throne too long without adapting. Your money deserves to grow, not just sit still. So take a look at your accounts today. Ask yourself, how much of this is truly serving me and how much is just sitting there melting away? A few small shifts can make a huge difference over time. Because the greatest risk isn't losing money in the market, it's losing time and purchasing power by doing nothing. And if you found this breakdown helpful, don't forget to subscribe to Taz's Money for more insights that help your money work smarter, not just harder. Remember, safety isn't about avoiding risk altogether. It's about understanding which risks you're taking and which ones you might not even see. Cash feels safe, but the numbers don't lie. In the long run, the real danger isn't volatility, it's stagnation. So keep your cash purposeful, keep your investments thoughtful, and keep your eyes open, because in the modern economy, even standing still means falling behind.